right. I think we're live, gentlemen. Well, thank you everyone who's joining. Give some time for folks to kind of trickle into the room or the space. But today's a very exciting session. I've been looking forward to this. Give us a break from the day to day gyrations of the market to talk about some of the building that we've seen on the institutional financial product side. We've got some really great folks joining us for that. We can kind of maybe start with some short introductions. I'm Frank Chaparro, Director of News at The Block, and then maybe we'll kick it to Dominic and then go around the horn. But basically, we're going to be talking about providing crypto exposure to investors via some of the same type of products that exist in traditional markets. And the number and scope of those products have boomed over the last several years, and we're going to dig into that. Thanks again to B2C2 for sponsoring this session. Hope it's valuable to our listeners. Dominic?
Cool. Yeah, thanks, Frank, and thanks for having me on, having all of us on. So I'm Dominic. I'm currently heading the trading and structured products business at Signum. We are the world's first digital asset bank, so we have a license here in Switzerland from the Swiss regulator, FINMA, a full Swiss banking license. And we're active basically in a range of services, anywhere from custody to trading spot and derivatives. We have a primary and a secondary market platform for tokenized assets. We're active in the lending business, so quite a broad range of services that we're actively engaged in. And I guess our clients are mostly institutionals. So from that side, I hope we can provide some interesting insights. And I'd say we already talked about this before. I would say we're probably the most Tradfi in this group of DeFi. So I'm really looking forward to have that conversation with the colleagues here as well. So thanks, Frank.
I was talking to Sebastian before yesterday to sort of pick his brain about a few things, and he noted that none of you guys are technically competitors, but hopefully maybe there can be we can create some sort of tension between you three on something. Yes, very cool typewriter on your desk behind you, Sebastian. We'll let you introduce yourself.
Oh, I'm Sebastian, the owner of that typewriter, also a couple over there, and also president of One River Digital. Some of you might know One River, but we're the first asset allocation. We're the first manager to make an institutional allocation to crypto. We did it back in November of 2020 when we bought $600 million of Bitcoin and ETH when Bitcoin was at 15,000, ETH was at 350. Since then, we've built out a dedicated investment arm. So a traditional firm went crypto, and we've got some great partners like Coinbase, Goldman Sachs, Liberty Mutual, and we're building across index, income, and active. And we've got also some of the best advice we think we could find. Folks like Jay Clayton, who's a former chair of the SEC, Jason Cummins, who was the chair of the U.S. Treasury Borrowing Advisory Committee. So we're really busy here at One River Digital, just trying to be a bridge between traditional and crypto markets, and that means products today. That also means technologies down the road, and we're excited to be here. Thanks again.
Yeah, you were on my byline this week with your announcement with Coinbase on your new SMA, so maybe we can talk about that. Forgive me, Johannes, it was you who I was joking with about the fact that none of you guys are competitors. But again, hopefully we can throw some soft punches at each other for some reason or another. Thanks for joining us from B2C2, Johannes.
Oh, thanks, Frank. Yeah, I'm sure we can find something to argue about. It's far too interesting a topic for all of us to agree. By way of introduction, I wear a lot of hats here at B2C2, although for today's discussion, I run options in Europe, and I also lead on the automated options trading globally. A little bit of introduction on B2C2. I suppose after the other two guys, I've got to say we're first at something. We were the first people to do an electronic over-the-counter platform. We are very, very big in the spot trading world. We're also offering CFDs. And about 18 months ago now, we launched a lending business, which has been very, very successful. And over the last few months, myself and my colleagues in the US have launched an options trading business. It's still early days for us in options, but it's incredibly exciting. We kind of see ourselves, again, we're not trying to be particularly exciting. We don't see ourselves as sort of the first movers on every sort of new technology. Instead, we see ourselves as the first movers in doing things in a safe way, in a sort of fully automated way, and trying to be sort of as resilient as possible. So one of our big focuses is, as a liquidity provider, can we provide liquidity in every market condition, no matter what? Can we provide liquidity through all of these shocks that we see in crypto? Can we provide liquidity through tech issues on other platforms, and just continue to operate as a sort of trusted partner?
I will say, as a journalist, I'm often very skeptical when companies say they're first to something. I try to opt for a pioneer. They're a pioneer on something, because there will always be someone who will say that they were actually the real first one to market. But it is true, B2C2 was very early on in terms of electronic trading before most of the big market making firms in crypto got in. If you remember those heady days pre-2017, I think I was talking with Genesis once about how people would show up to their offices in 2014 with big suitcases full of cash, right, trying to make a trade. So it's interesting to see the degree to which the market has evolved and changed. When most people think about the development of TradFi products, they think of derivatives a lot of the time. Over the course of the last year, if you look at open interest in futures and volumes, and then also even options, the growth of that market has just exploded. But maybe we can unpack the growth that we're seeing there. And to an extent, I think that growth has helped make it easier for more traditional firms that need those hedging capabilities, the ability to kind of manage their risk. That allows them to finally get comfortable enough to enter the market. So maybe we can start there with Johannes. How has the sort of growth of derivatives helped make traditional investors more comfortable with entering this market?
Gosh, yeah, I think there's really two big influences there. One on the regulatory side. Derivatives are quite nice from a regulatory perspective because they're already very well regulated. It's very clear what you have to do in most jurisdictions. And just because the underlying is a crypto often doesn't make a lot of difference to the regulation. So if you're a firm that's comfortable operating in foreign exchange or commodities or interest rates, and the regulation around the derivatives in those spaces, you're probably comfortable with the regulation needed for crypto. The other side of that is that one of the big challenges for a lot of our clients is simply being able to physically deliver crypto. This is something which, if you're a retail investor, is very, very easy. If you're a company, there are lots of reasons why this can be quite hard. And the derivative can give you exposure to the crypto asset without ever needing to physically deliver it. That makes a huge difference.
Yeah, absolutely. Dominic, one aspect of the market that's been challenging for some firms here in the U.S. and abroad is the lack of access to banking services. I remember when we got started early on at the block, that was even a challenge for us, and we're not, managing other people's money. How do you get firms comfortable with the suite of products that you offer at your firm?
Well, I guess I would put out a similar statement to Johannes, where we're actually probably not the most exciting ones in the market either. We really try to be as regulated as possible, and to a certain extent even as boring as possible, because it ultimately establishes trust, and we try to also leverage concepts that we have in traditional finance, such as, for example, the banking license. It's very fundamental to I would say convey that trust. And so I think what we've seen is, as you correctly said, right, a lot of banks struggling with offering access to crypto, or being open to actually crypto businesses. We of course try to be as open as possible. I guess it's in the nature of what we're doing. If we weren't, we probably wouldn't have a right to exist here. But of course, we need to adhere to the same principles, especially when it comes to AML and these topics, as all other banks. And there again, as I'm saying, having the same concepts in place, having the same standards in place, the same license in place. When you talk to a bank, knowing that you are regulated to the same extent as a UBS, as a Credit Suisse, we just talked before, some other Swiss banks, just helps in making sure that you have the same common standard. Yeah.
I don't know if you want to be that much like Credit Suisse these days, though.
I don't think we want to, but I guess having that license certainly helps. No, we're trying to move to new fronts, of course. Yeah, for sure.
So Sebastian, what does the appetite look like? What are clients sort of clamoring for, pounding the table for?
Yeah, so it depends on what client we're talking about. I mean, I think the reality is when people say institution, that is a broad umbrella, and we really think of that as kind of two big candidates within that, right? So I think many times when people say the institutions are here, what they mean by that are the hedge funds, in some cases mutual funds, maybe family offices, and in some cases even in limited cases a few corporations here and there for various purposes. But the reality is when we think about institutions, it's the asset owners, right? So it's the firms with funny acronyms like CPPIB or OTPP or AP3. It's basically, or any state plan basically take your state and slap on ERS and you end up with the state plans. Now the appetite there is completely different in aggregate, right? Because they're struggling, right? They see the opportunity, but when you compare real asset owners to hedge funds and mutual funds and let's say individuals at family offices, the incentives are very, very different, right? And the regulation that you're subject to is very, very different. So that drives a very different sort of engagement with clients. I would say the appetite, the interest in real asset owners is very strong, but the action is taking quite a lot of time. There is a new term that's going around the industry, DAWGS, Digital Asset Working Group. Okay, so there are a lot of dogs in North America, in whether it's in Canada or it's in Texas, or rather the entirety of the United States. But those dogs are groups of individuals that are trying to figure out, okay, we think we know why we want to do something in this space. Now, how are we going to do it? And that process will take not 6 to 12 days. It could take 6 to 12 months for many of these organizations. And that's what we're seeing in North America right now is a big growth in dogs, action plans that are shooting towards June or July, some sooner, some later. But in some cases, that's leading to product demand sooner than that. But it is very difficult for an asset owner to just make a decision to put some of these assets into their portfolio. They really need to kind of underwrite why they belong in their investment plan, because they don't exist, right? They're not in the IPS, the investment policy statement. They're not in the strategic asset allocation. So they have to go to their board and say, we should put these things into our plan, right? And why? And then they have to do how, right? The why and the how take a lot of time. And we're in the middle of that process right now.
This is more of a markets question than it might be a product question, but to what degree is the uncertainty around macro, the hiking cycle that we're sort of about to be thrust into, how is that maybe changing the way these allocators are thinking about getting into this market?
Yeah, if there was a rush to get in because you were concerned about inflation and that thesis is kind of broken. I mean, the industry, if there was a macro-based trading thesis, which I think most folks had going back to kind of March or April last year, that thesis is broken in the near term, right? You have rates going up, right? You have assets that were supposed
Goldman's
to
predicting 7 rate hikes.
Right. And you have an asset that people owned for this outcome, and it's not, CPI does this and Bitcoin did that. It's as simple as that. And so you have a cohort of investors who were long for a trade that isn't exactly working out. And put with that, there is some evidence of, and I'm sure Dominic and Johannes have views on this, but there is some evidence of, let's say, the folks that own tech, right, which is definitely rate sensitive, also being in this crypto trade, right? And when they're getting unwound on their tech trade, to what degree are there collateral effects for their crypto trade? So there's kind of you kind of have a space that is in the midst of a changing
identity
macro
crisis,
narrative, right? And the reality is we think there's a great story for the next 3 years for these assets, and we can talk about that later. But there's a cohort of investors basically were probably long for a thesis that's not exactly happening today.
It's a really interesting point. We kind of talked about this yesterday, Johannes, which is you have this thesis that is broken about crypto being this hedge to what's going on in the broader market, but there are still, even if that thesis falls apart for that one cohort, there's still this big yield opportunity for maybe another cohort. So you're not long directionally because you're buying into this idea that when CPI goes up, Bitcoin will also go up, but there are 20% yields you can get maybe in DeFi. There's new products that you guys are working on where it's kind of like a DOV structure or dual currency loan structure that can help institutions who maybe they don't buy into this thesis because clearly it hasn't panned out that much, but they can ascertain some juicy yields in the market anyway.
Yeah, that's right. Picking up a little bit on what Sebastian said about different groups, one of the groups that we see a lot of is the more crypto native type institutions. And for the first time ever, we're really talking about true institutions who are entirely crypto native. So they're not particularly interested in this macro problem. What they're really interested in is, well, actually, we're starting to see the macro events have an effect on crypto. That in itself is interesting for them. It almost inverts the equation. In terms of these yields, just the simple fact that volatility is so high in crypto gives this huge opportunity to turn that volatility into a yield. And there are quite a lot of groups, particularly perhaps not so much in Sebastian's sort of asset management world, but more so in the private wealth world. I know that Dominic sees a lot of this in Switzerland, who are really looking for just a way to earn a yield on anything these days. And crypto has a great story for that.
Are they banging down the table for yields, Dominic?
Oh, for sure, they always are. But jokes aside, I mean, I think what's really interesting is you see, like I would say, sort of two groups of investors into derivatives from a different dimension. So you have the ones that are comfortable taking the actual underlying exposure, which are going directly into options, into crypto, etc. Then there are the ones where you need to build bridges, right? The ones where you want to issue structured products for, where you want to have a securitization layer in between, which at the end of the day is really it's just repackaging the same payoff, but it's putting it in a format that they're comfortable with, that they're familiar with, and I think that's a way to sort of build that bridge that we are pursuing very much as a bank, being able to issue such products. I think we want to cater both types of investors here. Yeah.
One thing that might be interesting to sort of
Frank, just before you move on, I was going to mention on income. So while I said the narrative for kind of directional exposure to just one asset, is maybe broken for a cohort of investors, you're totally right about the demand for yield. We actually just launched a fund called Digital Income in a Delaware fund this week.
Oh, really?
Yeah. So and it's So I think one issue within yield is there's a bit of gray area, or confusion, right? There's so many different ways to generate yield. Some of these are regulated and transparent. Some of these don't have AML KYC issues, right? Some of these don't have protocol issues. And some of these obviously do have a lot of those issues. So I think one key thing that clients do really need to navigate is as they search for yield to think through, okay, do I have protocol risk? Do I know where this money is coming from, right? Do I have risk there? And so we launched our fund in part because we saw a really interesting opportunity around over-collateralized lending. So lending dollars against Bitcoin held away at a third-party custodian. This market is still growing pretty rapidly because most of the companies, I mean, B2C2 is a well-known name to us. We think the world of them, but they're not publicly listed. We still need to kind of take the entirety of the crypto infrastructure that exists and get it more publicly known. And up until that happens, this over collateralized lending is going to continue to be a key way by which we get dollars into the system. And we have seen, even with all that hedging I did about plans and where does it fit and all that sort of stuff, what we did see this, especially in the last couple of weeks, is that large state plans are interested in this type of really highly safe lending. Because if you can promise hand on heart, let's say 6 to 9% net full cycle, like we think that's possible with over collateralized lending, with no protocol risk, with no AML KYC issues, if you look at what fixed income portfolios look like in a state pension plan, this is a massive pickup on a big piece of their portfolio, right? And so I think that like crypto is very exciting, but ultimately for these end clients, they only care if it solves a problem for them. And I think you're totally right to dig into yield, whether it's coming from derivatives, lending, et cetera, because that is the biggest problem that state pension plans have, and crypto can play a big role.
Absolutely. I mean, I pulled up this piece from last May, and I think it might be the case, but maybe we can get a sense from Johannes. There's just a relentless demand for cash in this market, a demand for dollars among participants, and that's presents an opportunity for the clients that you're talking about, but also, I mean, there needs to be, we need to fill this gap somehow, right? And so I think that's a lot of what market participants are working on right now.
I find it fascinating. I mean, my background is in the foreign exchange world, which is frankly the most boring end of trading. And I say that having run a whole career in it. But the stuff that we can do through this huge demand, as you say, for cash, interest rates on dollars approaching 10% at times. That's unthinkable in the rest of the world. And here it's there for a good economic reason. You can get that interest rate with proper collateralization, as Sebastian says, and so it's a real trade for somebody who doesn't want to sort of take a lot of risk but still wants to get a good yield. And what I think is really interesting is when you take these disparate interest rates, and we see this in other places in crypto as well. For instance, if you look at different exchanges, every future on every different exchange has a different implied interest rate.
There's no real rate in this market.
There really isn't. And there are lots of people talking about how do we set a reference rate in crypto. Well, what I find really interesting is what is the reference rate for dollars in the crypto economy? There isn't an answer to that. And this then ties in a lot to a lot of the derivatives, because almost all of the derivatives take interest rates as a major component of their pricing, of their value. So this means that for two different people, an option simply has a different value, because interest rates are at 10%, and interest rate is a large part of the value of an option. Same is true in the forwards world. The same is true if you come to these sort of more complex structured products. The underlying interest rate, even though it kind of gets hidden and you're manufacturing yield and you're doing all sorts of things, this underlying interest rate and the fact that it's very different for different market participants creates some really, really interesting dynamics.
How does it impact the sort of products that exist on top?
Well, at the simplest level, if you just look at something like a non-deliverable forward, that in the foreign exchange world, we would say a non-deliverable forward has a well-known value because you know the interest rates on the two underlying currencies, you know the spot rate on the underlying currency, and from that, there's a very simple formula, and you can just read off what the value of the NDF is. Now, it moves around a little bit either side of that, but it really doesn't move very far because you'd have this arbitrage condition. In crypto, that's not true. If you were to go to two different liquidity providers, they may well give you different NDF rates, and they may look like they're arbitrageable. But if you can't realize that interest rate difference, it isn't really arbitrageable. If you as a market participant have a different interest rate to your liquidity provider, you may see an opportunity for you, and that's great. That's a legitimate opportunity. It's not to say that the liquidity provider is losing money on it either. And this works in all sorts of interesting ways. So we can bring in, this is fundamentally the reason why we can say to new entrants to the market, here's 10% on a dollar loan. It's really exciting.
And it speaks to the degree to which crypto as a market is still relatively immature compared to FX, where you're from, or U.S. equities. Mm-hmm. Have you guys found or seen any instances in which crypto market participants have improved upon the basic structures of a traditional product, financial product, structured product, derivative, relative to traditional markets? Is there anything that we've done better? Because a lot of the time the conversation is about, okay, well, we're missing this, we're missing that, but has there been any true innovation in terms of the structuring of these products?
I mean, I was going to say the dollar, right? Like, I think, it's ironic that,
I guess we don't really think of stablecoin as a product, but it is, yeah.
But it is, and I think it's really fascinating because we spent a lot of time researching and engaging with the potential of basically the macro potential that could come from the dollar becoming, again, the reserve currency, but truly like the fiat standard, right, via stablecoin. But the power of stablecoin is basically ignored by almost every casual market participant because they focus on the volatility or returns of pricing of Bitcoin and Ethereum. They look at their yield opportunities in DeFi, and that's where the attention is. But you could argue that the macro implications of stablecoin are really massive and completely missed, right? If you don't need to hold cash in your balance sheet because we finally found money velocity after killing it for 20 years, right? Money velocity has actually returned, but it's via stablecoin. I think that's very obviously better in many ways and probably really underappreciated. And the implications for how corporates run themselves, right? When you do cross-border payments and how much cash do you need to have in reserve as given the velocity, I think it's really mostly misunderstood or just kind of not even noticed. But yeah, that'd be one example.
I think
it's a really good one.
I was going to say, all of these things are tools. These derivatives are tools. Crypto itself is in many ways a tool. And for me, the stablecoin is that. It's that sort of Swiss Army knife. It can do absolutely everything, and it sits in the middle of everything.
It stands to reason that Silvergate then snapped up the remaining assets of Diem. They're looking to build a big business around stablecoin. Dominic, is that something that you guys are maybe looking at as well?
On stablecoin, sorry, specifically, or
yeah.
No, we've actually issued a Swiss franc stablecoin, which we're capable of doing in the position of a bank, right? So we're holding that fully collateralized with the Swiss National Bank, and we've issued it, and it serves a very specific purpose, namely the one where we have tokenized assets, right, that are on chain fundamentally, and we want to give clients access to them. And so if you have one leg on chain, the other one off chain, well, it's never going to be a truly decentralized setup. So what we did is we just replicated the Swiss franc on chain, have it fully collateralized, and that allows us to have a DEX basically up and running for tokenized assets. So I think that's quite a cool way of doing it, and yeah, so I hope others will also follow that, and we'll see similar projects.
Yeah, it's definitely interesting. Maybe we can focus a bit on because I think it's an interesting trend, the development of dual currency loans. We talked about it yesterday on the phone, Johannes. How is that shaping up as a new product?
I mean, it's almost the oldest product in structured finance. It's been a mass market product in traditional finance since possibly the late 80s, certainly the early 90s. In the FX world, there are some banks doing billions and billions of dollars a day in this product. If in Japan, this is a retail product to the extent that your retail FX broker, you can just log in. Anybody can just log in and do this. We're starting to see that in crypto. We've got things like the Binance Yield platform. And I think this is a really, really interesting one because it's really simple. It's a product that everybody can look at, can understand, but it also serves a real need. And the need that it serves in traditional finance is exactly the same as the need that it serves in cryptocurrencies. And that's whether you're trying to earn some yield or whether you've got a genuine need to convert one currency to another. Either way, this is a totally useful product. I think the development of these structured products has to start with these simple things that are well understood in the traditional finance world, but are also very, very easy to bring into crypto because they're so simple. We don't have to develop a huge load of infrastructure to support this because it's something that we can all just put together kind of in a week. And that we have to start simple with things like this, and then we can move on to the full suite of structured finance products.
You think, I imagine there are some folks who might look at what's going on in crypto and say, are we just reinventing the wheel with what Wall Street has done? If you're going to take a pessimistic view of it, is it really, are we really just creating the same instruments that led to our downfall during the financial crisis?
Well, I mean, I don't think we're doing. There's an argument there around credit derivatives. I don't think anybody's doing that sort of, or those sorts of sophisticated credit derivatives yet. I don't know that they have a place in crypto, partly for this reason of the different interest rates, and partly for the stablecoin. We don't need those tools because we've answered those needs in other ways in crypto, or because that we just have other problems. So it's really only a subset of these Wall Street things that we're taking in. And my hope is that we can bring together these sort of interesting innovations from the crypto world, the DEXs, the tokenized assets, the stablecoins, together with what are frankly pretty simple and very well tested ideas from Wall Street to answer a real need.
What say you, or Dominic? What say you?
Yeah, no, just because Johannes mentioned credit derivatives, it was actually one of the things that I thought about would be particularly interesting to do in a decentralized form, because you're not just shifting counterparty risk from the object you're insuring to the issuer of the insurance, but you're taking it out of the equation, right? So I think as long as we're having centralized entities in this market, such as exchanges, custodians that are huge in this market, I think there is, in my view, a potential. And I think, at least to the extent that I know, I haven't really seen that yet, a CDS or an equity default swap type of product in a decentralized form. But I would be very curious to see that, especially on some of the major exchanges. And I could imagine that it could be an interesting product to trade in a decentralized form. But it has to be decentralized. Otherwise, again, you're just shifting risks from one entity to the other, right? Which then we're back to 2008, etc.
Frank, I would just add one point, just a high level point that I think, for those that were working during the GFC, you can remember this, but I think the thing that's really attractive about crypto, and we believe, by the way, that crypto will be the underpinnings of the financial system. We think that that's good. Are you seeing prior behaviors trying to build on top of this new better infrastructure? Sure, of course. Are 100% of those prior behaviors perfect? No. But I think that one higher level of, outcome of crypto is the transparency, right? So if you go back to the GFC and think about what it felt like, right? That moment when you said, well, Jude, is my dollar actually a dollar at this bank? What are the liabilities of these entities? Have they marked their books correctly? And the outcomes were very stark. Remember, if you go back to Lehman, if you were in their arranging platform in Europe, you were a general creditor. If you were rather in their US broker dealer and you had a Reg T account, you got your assets, right? That sort of, we're so far away from that. But it helps us. I think it helps to think about crypto in that lens, that we can have so much transparency about what is happening, where the risks are, where the leverage is building, and not really worry as much because where the issues are. And I think that's just a very, very different environment than what we're used to. So, and even more recently, I'm not going to mention them, but obviously there was an issue with a hedge fund that was over levered and it caused losses, right? Because they were doing stock lending. Those issues are, we have our own sort of market structure issues, obviously, as crypto is evolving, but at least the transparency about where things are and how they're evolving, I think is significantly enhanced. And I think that the ability then to understand what's happening, and then to not overreact is probably better. But we're still figuring it out, I think, as an industry.
Sebastian, are you not saying the hedge fund's name because no one really knows how to pronounce it?
Oh, we all know. Well, you say it 3 different ways.
I have no idea how to say it. I probably pronounced it 6 different ways. It's a really interesting. I mean, it's as simple as you can check the chain, right? It's right there, so you can get a better sense of the risk that's baked into the system than you would otherwise at a more kind of opaque institution. I always check when I'm moderating these panels if there's any regulators listening in to know the degree to which I should watch what I say. Maybe some lawyers, but I don't see any regulators. Is there enough clarity for maybe some of the folks that you're engaging with, some of your clients on the regulatory side to enter this market? Might be a trite question, or are there still remaining lingering regulatory concerns that are keeping them from entering?
I think it depends a bit on two factors. On first of all, the jurisdiction, obviously, that they're in. So I think there's vast differences among the jurisdictions. In Switzerland, we feel like we have, and I'm not saying this in being afraid of having a regulator in here, we have quite a progressive regulator. We have a regulator that we can talk to about these things that we have an active conversation about. For example, when we were launching our options business 2 years back, we actually had an active discussion about this with the regulator. How should we go about it? What's the capital underpinning, etc. Because a lot of these frameworks just didn't fit crypto, right? Just simply because crypto it wasn't traditionally an FX. It wasn't really an alternative investment. It wasn't really anything that anyone knew. So we had to fit it into a new frame, and I think that frame we built together with the regulator, among others, of course, right? And then the second aspect is, I would say, risk appetite as well, right? I mean, when there's uncertainty, how far do you go? How much risk do you take in when you don't know how it's regulated, right? And I think that is really also then, I guess, company policy and risk policy, at that extent. So yeah, that's a bit how I look at it. But yeah, I guess every player that comes into the market with new products helps makes a blueprint for others to work with. Yeah.
I would say that.
Go ahead.
Sorry, yeah. Ironically, I would say that for simple products, there are still challenges, and it's the more complex products where it's a bit easier. Simple products like simple spot crypto, which is now regulated in one form or another via the virtual asset service provider framework, which exists in different shapes in all sorts of jurisdictions around the world, is a challenge, and nobody's quite sure what shape it's going to take over time. More complex products like options, like these structured products, they fall into the existing regulatory framework, so they're very easy. And then coming back to simpler products again, once you look at the sort of asset management type products, there isn't an entry in the column or sort of in the list of asset types for crypto for so many things, and that causes a lot of confusion because some people take the approach of, well, there's not an entry for it, so it's not regulated. Other people take the approach of, well, there's not an entry for it, but it probably is regulated, so I'll use I'll behave as if it's one of the other entries in there. And some people take the approach that, well, it's not in the list, but it is probably regulated, so I'll sort of make something up. That's probably unfair, but there is a lack of clarity there, and that hopefully changes. I know there's a lot of work happening. We have regular conversations with the regulators. I know that you do in Switzerland and in the US. The regulators are looking at this very, very hard. I think there will be clarity in the very near future, but right now there's a real lack of that.
Yeah, I mean, look, in the U.S., I think it's obviously well known the Biden administration is due to come out with an executive order to provide a little bit more direction. Various federal agencies have been doing different things, but there's a variety of things that have already occurred that clients are still needing to be made aware of, right? And for everybody on the screen, it would be shocking. But even like last week, we have clients that are asking us, "Is this legal just to own Bitcoin?" Right? And you have to go back and send them the 2014 letter from the IRS, right? You have to go back and send them, evidence that the U.S. federal government itself has transacted in Bitcoin, right? Federal marshals seize it and they sell it into the open market. And you have to remind them that we now have, of course, CFTC regulated futures for Bitcoin and Ethereum, and all those things are not broadly known. So I think we all like to be in a more developed state in terms of regulation. And there is overlap in some of the activities that you see. But I think we're headed in the right direction, but it's still a work in progress. And it is definitely something that causes hesitation, especially when you're talking to anyone who's kind of more of a public investment plan, because they're far more risk averse than say a profit oriented investment manager.
And even still, even with all those questions and the questions around the tax implications, we've seen a few large corporates, two that are fairly well known in Tesla and Block, actually put some Bitcoin on their balance sheet. That could open the door to a new business opportunity. If we think about treasury management for crypto, I was talking with a trader last week about the ways they're working with firms to expand the scope of what they're doing with their holdings on their balance sheet beyond just a directional sort of buy and hold type of function to a more operationalized function. So how can you take the crypto that you have and either leverage it to engage with different ecosystems, or maybe you're staking your coins or something else. But this is kind of a new phenomenon that we're at the cutting edge of.
Yeah, I think this is really interesting. And I think this may well be the big growth story of the next year in the institutional space. Is there are all these relatively simple services around just management of the cash in a bank account or management of assets in a fund, which are not yet mature in the crypto space. And I think all three of us here are working very, very hard on that. And it's whoever sort of figures that out properly over the next few months is going to do very, very well. Sorry, go on.
I'm going to put some water on this one. Every time you end up with something with 4 letters in your acronym, you're in trouble. So GAAPIFRS, right? The problem is that crypto is deemed an intangible asset, right? So it's heads. So tails you lose, heads you don't win, right? If it goes up, it doesn't change. It does nothing to your balance sheet, right? If it goes down, you have to mark it down. And by the way, obviously, if it's minimum 50 vol asset, you're definitely going to get to mark it down after you buy it, for sure. Right? The probability of that's basically 100%. So that becomes a real big issue. Now, and we were talking in our prep call, there are instances, if you look at using a fund versus direct, it solves the accounting problem. I don't think that's actually what any corporate would want to do, rather, as much as we would love to see it into our funds. I think you're really going to need to see a groundswell around the accounting for these assets to unlock that demand. I mean, in some sense, if you think about corporates and asset owners, right, they both have these massive impediments to adoption. Corporates, it's around accounting. Asset owners, it's around their own internal processes, those two big, the IPS and the SAA. You need both of those things those things can be changed by themselves, right? But it's a firm by firm decision. You really do need for corporates to embrace this in a big way. I think that they really need some relief on the accounting side of things.
It doesn't look like the SEC is going to give them that relief. We saw MicroStrategy's proposal struck down, causing their stock to plummet. But who knows what the future holds? We could see that change at some point. Covering this space, one of the fun, well, I don't know if fun is right. It's a bit too much. Don't want to get too much pleasure from massive liquidations, but it's something that's interesting to watch. We see these cycles play out, or time and time again. Offshore trading in futures kind of lead to these big blow up events where there's cascading liquidations that further bring the price down and further stomp out certain traders offshore. And then always you see large buyers enter the market at that bottom and gradually buy up that dip. It's I think that trade might subside over the coming months potentially, but it speaks to the juxtaposition of the amount of product leverage there is for retail offshore and probably the lack of leverage for maybe some more larger institutional clients who talk to me about the real hunger or thirst, desire for leverage in this system. And it seems like there's a lot because of what's happening on these retail platforms, but there actually is not that much.
Well, I think it depends a lot on what client segment you're talking to, right? I mean, leverage to that extent is a retail phenomenon to a large majority, right? So I think if you look at the spectrum from, I want to take leverage exposure. Then in the middle you have I'm happy with Delta One, and then on the other side I want to be hedged, right? And I think we're trying to serve, all of us here are trying to a certain extent serve that entire spectrum, right? And I think it's probably skewed towards the retail when you look at the full when you're looking at the full leverage end of the spectrum. So what we're seeing is derivatives being more used as a tool to hedge exposure actually than to gain additional exposure on the institutional side. So I think we're seeing a lot of covered calls, for example. It's something that I would say makes up a decent chunk of our flow, and I'm maybe Johannes, you can give some insights on you as well, but that's I would expect we see similar phenomenon on your side as well. So yeah, especially if we're looking at institutions, it's more about decreasing risk than increasing risk, actually, to be honest. So I think this is a very retail driven phenomenon in my view.
Yeah, we see it slightly differently, but I think we're seeing a slightly different geographical distribution of clients. And also we see a real difference between the crypto native institutions and the sort of, the if you like, external to crypto, but very interested in it type of institutions. The crypto native institutions are very much using derivatives as a risk adding activity, as a way to express a directional view. Not necessarily a directional view in the underlying crypto price, but a directional view in something. Again, sort of regionally in Europe and the US, yes, it is primarily a hedging product, with the exception of some hedge funds. And there are some very large hedge funds participating in Europe and the US. In Asia, we see it much more as well, largely because there's so much yield enhancement flow coming out of Asia. It's really a risk adding type of product.
Interesting. So there's differences between different geographies in the way certain clients are engaging with derivatives. When we think about maybe someone asked an interesting question about managing exposure risk across DeFi protocols. This is a sort of new world. There are opportunities, but questions around KYC, AML. You have MetaMask working on an institutional offering. Aave is as well, kind of trying to create a wall gardened area or niche for institutions. Is it possible to engage with these protocols in a meaningful way, and at the same time manage certain risks, whether it's hack risks or KYC, AML risks?
Well, I'll just say we're being very, very conservative in this regard, right? We think that there's a lot of work that needs to be built on basically the layer before we get into any of these protocols, and we are not convinced that that you can confidently move into all these areas without risk. Let's just presume that you're comfortable with the AML KYC setup of these protocols, and I'm not giving any sort of okay in that regard, but you still have technical risk, and I think if you just back up on DeFi and think about what is it trying to solve, right? I mean, ultimately, like, we have to solve a problem, otherwise, what's the point? And you could say, all right, well, look, NIMs or net interest margins are somewhere between 2 to 4%. Does that make sense? Can we grind those down and get more capital into the hands of entrepreneurs in the right, with less of a charge? Yeah, sure. I think that's definitely possible. But the process from the process to get there, we think it's very much at its infancy. I mean, I was over at, and I'm sure this is probably not the best place, but DeFi Llama. What is TVL right today for DeFi globally? What, 210 billion, right? This is infinitesimal, right? And that's exciting because there's so much more that can be built. that hasn't quite happened yet. So we're taking a very conservative stance. I mean, we're rushing ahead to build bridges for institutions, but in this regard, we think that there's a lot that needs to be built yet that doesn't quite exist, and we're looking at all of these things.
We have a similar view. It's very, very interesting. We're having a load of conversations. We have yet to find anything that satisfies us, but we are having conversations that are definitely going the right way. I think that's all I can say about it. Yeah, watch
You
this
heard
space.
it here first, folks. There was this story in the FT about Genesis Global Trading accepting NFTs as a form of collateral, and they mentioned that they're building out some sort of platform for liquidity and hedging needs in the NFT space. Maybe on the asset management side, we can look at Bitwise, which has launched some sort of NFT index. Where are we in terms of the development of institutional Tradfi-style products for NFTs? And it's pretty funny that it's actually a thing. I would tweet about it almost as a meme, so to speak, and it kind of memed its way into existence. Institutional NFTs or institutional NFT products.
I think there's something that's really powerful for everybody on the screen here. If you just think about, and I'll steal this, is Raoul Paul said this. If you understand NFTs, like NFTs unlock everything, right? And what I think he meant by that is that we are taking these real interesting things. I mean, they might be a JPEG today, but right, you're taking something and creating an asset, and the idea that you can tokenize assets. So I would call a painting real, right? Even though it's on the screen, it's still real to me. To take real assets and then start to tokenize them and is great. And I think the big idea is that you will start to see tokenization of assets in the real world being pulled into crypto, right? And so the TAM, the total addressable market for crypto services, is going to explode in our view, right? And whether it's an index of NFTs or it is, what Dominic and I were talking about, I think, Dom, you were saying that you were fractionalizing Picasso. Is that right?
Yep, exactly. Yep.
Yeah. So just thinking about the ability to democratize access to assets, right, and to grow the total addressable market for what you can actually own in crypto form is really very powerful, right? And so Frank, you're right. We're working on indices of all sorts of things because we see the world of index management becoming much more broad because far more assets can actually be brought into kind of a liquid index sort of research idea.
Yeah, absolutely. No, and even one step beyond the Picasso, we tokenized a CryptoPunk because we felt like we want to give ownership back to kind of to allow more people to invest into it. Was a project that we did also where a lot of our colleagues, employees were able to invest into it. Even if you didn't have 100 Ether laying around and just be able to invest that into a CryptoPunk. So that was quite a cool project. So we're experimenting a lot, I would say, with NFTs. But back to your question, where we stand when it comes to TradFi products on NFTs. Well, nowhere, to be honest. I think this is really, really in its infancy, and I think we're even 2 or 3 steps behind any other underlying. So yeah, I think there's a lot of potential there still, for sure. Yeah. And I think a lot of the ideas even haven't really surfaced, to be honest. I think there's so much potential for new ideas, and when it comes to TradFi products and NFTs, because they're fundamentally new product, right? They don't exist in that way in the traditional market. You have options, as John has said before, right? An FX option and a Bitcoin option is not that much different, but an NFT is a fundamentally new concept. And so I think there's a lot of potential for like groundbreaking new products that just have to emerge now.
Sebastian, get your team to start working on a SMA for NFTs. We need more acronyms, as many acronyms as possible.
Well, Frank, I will say, so yes, you're right. We did announce one digital SMA powered by Coinbase earlier maybe it was on Friday. All these days blend together as crypto. There's no thing as a week anymore. But if you think about an account, right, and what it can hold over time, the idea that your wallet if you think about wealth management, say they're saying, okay, how do I get Bitcoin and Ethereum into my existing traditional setup, right? And the conversations we're having with investors is saying, yes, that is definitely something we want to deliver, and we're going to deliver you an institutional index. But think more broadly about what this wallet will mean for your client, right? And what we're talking to the wealth managers is about their total addressable market as a wealth manager expanding dramatically. As like for example, the art market is a $6 trillion market, and digital's like $2 trillion today, right? As crypto starts to bring more asset classes into it, the strategic value of having a wallet for your client as a wealth manager goes through the roof, because today it's two assets that are really volatile, right? Down the road, it may become the way by which you as a wealth manager are delivering investment services to your client, because you say, geez, my client wants to invest in art, right? Dominic I can go get a fractionalized piece of the Picasso, right? Do you want that to happen as a wealth manager away from you, or do you want it to happen in your client's wallet? All those things are on the table because we see kind of where we think the future is going with tokenization. And those firms that embrace this, right, ideally with us, but those firms that embrace this are going to be on the right side of kind of the ultimate bridge that's built between crypto and traditional, as traditional assets also get pulled onto the chain.
So that's the long-term pitch there to the wealth advisory community.
Yeah.
That's
the short-term pitch is your clients, look at your outflows. What are the biggest outflows you're seeing? Your outflows are going directly to crypto exchanges because clients want these assets. So some of them are doing it for purely defensive reasons initially, but almost all the firms are fiduciary for their clients. They all are fiduciary for their clients, and they're trying to say, okay, I have to solve a business problem. But when they look, they say, wow, this is really transformational ultimately for our business. It actually could turn into a bullish thing for our business as opposed to pure defense. And I think that is kind of the change that we're seeing for some of the wealth management houses right now.
I mean, even talking with some of the smaller robo-advisory shops over the past year, Betterment and Wealthfront as two examples, you hit the nail on the head there, Sebastian. Like when they see where the money is going, because you can link their accounts up to these external accounts, and there's just a ton of money moving off their platform into crypto brokerages and exchanges. And both of them, which were pretty skeptical of crypto only a few years ago, both kind of moved in to the space to use your word, to sort of play defensive and keep that attrition from continuing to happen. But it could serve as a growth lever in the future, not just one that keeps them from losing client assets.
Well, I like cars, right? So if my wealth manager could sell me a fractionalized ownership in like the tiniest piece of a famous Ferrari, or that is an asset that has kind of an interesting value, and in an inflationary environment, that's art is the type of thing that people want to gravitate towards. And if we can fractionalize a Picasso, right, we can fractionalize all sorts of things, and I think that those assets are going to be increasingly in demand. But how do you deliver them? You're going to need a wallet for your client, right? So what we felt strong conviction to spend resource and team up, and we're rushing ahead as fast as we can.
Super cool. Well, I really appreciate you guys coming on and chatting through all of these really interesting topics that span institutional TradFi products in crypto. Really wide ranging. I think everyone did a phenomenal job, and I appreciate the folks listening in for joining. That's all for now. Hopefully we'll see you again soon. Thank you very much.
Thanks, Frank.
Thank you.
Thanks, Frank.
Thank you, everyone.
Thanks, everybody.